Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, capital losses negating what people have gained was yesterday's, I call it a red-letter day on the Dow, losing 800 points. Is that kind of the message you're trying to tell people, that things could not be worse or better?
Well, the point of everyone talks about the volatility, but the volatility really misses the point. The points are these. Everyone's expectations for returns in capital markets are premised on this notion of compound gains. Compound gains are where an interest and income is continually reinvested in new units of different investments, where there is zero taken out in terms of fee withdrawals or zero taken out in terms of income withdrawals. So it assumes this kind of closed ecosystem of perfect conditions where everything is reinvested, where no big lump sums come in at a particular time, or no big withdrawals are made at a particular time, just a continuous sort of loop of this perfect system. Well, of course, that's not the reality for anyone. Pretty much everyone pays some kind of fees, first of all. Secondly, most people, especially as they move into retirement, start taking withdrawals from money. And thirdly, as I've explained many times, the way that capital formation happens in real life is very often in lumpy parts. So people sell businesses or get inheritances or downsize property, and they get these big chunks of their life savings liquid later in their life. And so it matters very much what price and any capital loss that happens when that principle is put to work. So when you're coming into a time when we've had the longest expansion in market history, when valuations are as egregious as they were in the peak of 29, in the peak of 2000 in many cases, certainly at the peak we're higher in many ways than we were at the valuation tops in the market cycle of 2008-9. And so what happens is that it's very likely that you get a significant drawdown followed by years of trying to grow back principal. And this devastates a presumption of capital gain and presumptions of investment return. So, no one's factored in any idea that you could lose a chunk of principal and then, still be trying to take out withdrawals, which most retirees do during bear markets, and how that just evaporates principal. And totally knocks off all retirement plans or withdrawal expectations of how much principal one should have and how long it should last. Is just devastating to the math of it. So you really can't afford to buy into those fantasies. And so what we've seen in the reality of where we are right now is we've been talking about for many months a world where yield curves, which is the bond market, which is much considered, the treasury market is considered the sober big brother, if you will, of the stock market. Treasury markets have been indicating a slowing economy in the entire world, pretty much for the last year and a half. And they've been inverting yield curves all over as central banks were trying to hike interest rates to put on a strong face as if they'd a fait accompli in terms of, successfully had a soft landing and now they were going to be able to ratchet up rates. Well, of course, they didn't get very far with that before tumultuous events began to unfold, including these drops. So now we've got an S&P 500 which has gone nowhere for 18 months with enormous volatility. We've got a Toronto Stock Exchange which has gone nowhere for 2.5 years. Today we're back under 16,000. This is the same level that we were first in early 2016. 17. And so, people are holding on in the hopes that this is just a passing volatility when it's more likely to be the next bear market. And yes, it's been stalled and extended and put off, but it hasn't solved the reality of a business cycle and a market cycle. It has simply extended it and made it that much more dangerous to the downside. So I'm trying to warn people that, it's not okay to be complacent in this environment, to be passive. It's fine in theory to say, well, I'm not going to sell if things go down. I'm just going to ride out the volatility. But what they don't appreciate is that in this environment of a secular bear of, as I say, extended valuations on every historic metric, it's more likely that you're going to have this big drawdown and then years trying to get back to where we were. And that is not good for retirement principle. It's going to be very difficult for pensions because, again, they've been sort of rolling the dice and hoping to grow back and finally get into positive compounding again. But they're facing, of course, escalating withdrawals in this aging population and less people putting in funds. So we've really set up for a very disappointing capital event here, and it's going to have a dramatic effect on people who are that much older, 10 years older than they were in 2008, 20 years older than they were in the tech wreck. So it's much harder to heal after these events the later and longer you are in your working career and indeed if you're into your retirement.
Also, this call for declining interest rates, has that not been one of the biggest reasons pension funds have been devastated?
Well, so here we go. We are now, with the 10-year, Canadian 10-year Treasury today, is back at a level, it's just, very close to the all-time low that it had in 2016, at, so under 1.1%. You've got the entire Canadian yield curve from 1 month to 30 years significantly below the Bank of Canada's 1.75% range. We've got a precedent for how horrendous and devastating these low rates and negative yields are to pension funds and banks, which we've seen in the precedent of Japan, who's been leading this mess for the last 30 years in the increasingly interventionist policies, which have not worked and have created great deficits as far as the eye can see. So we're seeing this now moving, it's been bullish for North American treasuries in the last few months because the world is dealing with something like 11 trillion now of negative yielding treasury debts in other parts of the world. And so pensions and insurance companies, the institutions that must buy bonds to match with their obligations to pay out, are facing the reality of not just no yield, not just nothing to compound the growth with, but we're talking about negative yields, so getting back less than you put in. This is really just throwing the math completely out the window for how these plans are supposed to work and how they have for centuries. So in this scenario, although it's been positive and our North American treasuries have been rising as everything else has been falling on the corporate sector, the reality is that at some point here, putting new money to work is getting increasingly more difficult in Canada as well, because if you're trying to buy treasuries, for example, and your yields are, even you buy a 30-year bond today, it's 1.3% in Canada, and it's even so as you're doing that, it gets harder and harder to find any positive gain, and the impacts to, as I say, everyone's expectation of return over time is very negative. So the best scenario that I can really point to here is that it appears that this bear market is finally underway in the world, and that although treasuries will probably rise as the rest of the sectors fall, including corporate debt, which has been extremely overdone this cycle, at some point yield will get better on the corporate side. So you will be able to buy things like dividend-paying stocks and corporate debt with yields that'll be worth owning. So even though treasuries may continue to be low for a long time, even though there's no probability that central banks are going to want to increase rates, they're probably going to continue trying to figure out how to ease conditions in this environment with the slowing global growth. But the reality is that the treasuries will there's not much more yield to be had on that side. There's some capital gain growth to get there, but basically you have to wait for the repricing on the corporate side. And once that happens, there should be across-the-board opportunities. And in Canada, this is likely to impact the real estate sector as well. So if you're looking for, to pick up rental properties at some point, having some liquidity, for example, is a good idea now, because you may get the opportunity in the next year or two to get things at much cheaper prices than you've been able to for over a decade in Canada. And I think the really important thing that is also good to note in this environment is that when we have these massive sell-offs like we're having this week, like we had yesterday, for example, every single sector in the corporate equity side was underwater, right? Every sector was falling. So there's no diversity benefit in holding all these different colors of equities. All the mutual funds that hold them, all the ETFs that own them, the individual shares themselves, every sector, even the supposedly defensive ones that were paying, income to retirees and all this, all of it was plunging, and on very high volume, especially for August, right? August is often, the dog days of summer, and you don't typically see, you can see a lot of volatility in August, and it's quite often a negative month, but you don't necessarily see a lot of volume to the downside. There seems to be a disturbing urge here for people to sell en masse, and I think that's because there is so much, as we've discussed before, leverage and overextension in this market, people that have borrowed on borrowed on borrowed to buy things. And once you get these clearing events, they are forced to sell everything they can just to raise liquidity. And I think that that's the kind of market we're in. And then you get stories, yes, there's all the trade tweets and all that nonsense that's going on. And as I've said before, that's not likely to be fixed easily, because that's a massive imbalance in the global economy that's built up over many years of behaviors and policies, and is not likely that China's going to change how it's doing business quickly. And so I think we're at quite an impasse there. However, the other things is stories, for example, like GE today. Did you see that? So Harry Markopoulos, who was infamous for calling the whistleblower who called the fraud in the Bernie Madoff scheme, and of course, infamously, then he went to the SEC and told them, sent them reports, and it took them years and years and years because Bernie Madoff was such a central figure, was so revered unduly, as it turns out, was so, involved in the New York finance scene that no one could believe that this could be true. Well, now we have Markopoulos' company having done a year-long research project on General Electric. Okay, General Electric being what used to be sort of the bellwether of all overall markets. It was considered, especially in the 1990s cycle, the late 1990s when Jack Welch was at the helm, it was considered, one of the best companies you could ever imagine, and he wrote all these books on how he managed it and everything. Well, Markopoulos' report says that they have actually been undergoing massive accounting fraud that reaches back to when Welch was at the helm, and that they haven't taken significant enough reserves to offset the obligations that are coming up on their long-term care insurance units. So you think about this. This is the demographic story, right? So this is the aging population. This is the reality that they had sold all sorts of insurance contracts to cover certain benefits, but with interest rates falling the last 20 years, they continued to get less and less in terms of yield and availability to match bonds to those obligations. And so their expectations, just like pensions and individuals, of what they thought they were going to make has not panned out. And apparently, if this report is accurate, they have been taking steps to hide this through financial engineering. So they're saying that this is literally a larger fraud than was seen in WorldCom and Enron combined, and both of those two companies are no more, as you. So it is a very significant story, and I think that as this goes along here with the downside coming into view, we're going to get a whole lot of stories about the shenanigans that have gone on, the fraudulent activities, the financial engineering, and this is going to continue to shatter the public's confidence, which was misplaced in the first place in this whole sort of Ponzi-like environment we've been living through. And so a clearing event is likely. That will be extremely positive because there's no way out of this without actually having weak players fail, having people arrested for financial crimes, culling the system, so to speak, and price pressure will be the catalyst there as things begin to go down and selling accelerates. That's typically what brings about all these pain thresholds and then prompts regulatory investigations and whatnot. So it's all very positive, but for individuals, I suggest that they take a very hard look at their risk exposure. I know I say this frequently, but if you were suffering, for example, in the fourth quarter of 2018 and you've been elated that things rebounded in the first half of 19, you are holding a lot of risk. And you should have another look at your portfolio and your savings and make sure that you're not unduly exposed to the forces that are at play at the moment, and that you do preserve your liquidity and ability to buy once things finally come up on great value.
We'll have more with Danielle Park right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome back. We're speaking with Danielle Park. Danielle, General Motors and Volkswagen, are they now jumping into the electric vehicle business in a big way?
Yeah, for the catalysts outside of their own decisions, let's say, but certainly in the case of General Motors, they finally announced that they are going to really double down on electric engine cars. They're not going to bother with the trying to create hybrids. They're going to discontinue their hybrid lines, and they're going to go straight to electric vehicles. The catalyst here, of course, is China, who brought out rules saying that if you want to sell cars in China going forward, that you have to offer a significant portion of zero-emission vehicles. So this was what made them finally decide. At the same time, of course, there's the Volkswagen, which has been buffeted by the emissions scandal and fraud, where they have been covering up and lying about the amount of CO2 emissions coming out of their tailpipes for a long time. And so I think in their case, they also want to try and convince the public that that they've changed their ways, that they're moving to a clean emissions vehicles. And so that's the big story this week. They both say GM plans to launch 20 fully electric vehicles worldwide just in the next 4 years. And VW is sort of spending billions on their own versions. At the same time, you have companies like Ford and Toyota who are so far not doing that. Toyota's saying, well, we can't make money selling battery powered cars, so we're going to stick with hybrids because we have higher margins on hybrids. Again, I think they're making a big mistake. I think that, the cost of batteries is coming down dramatically. And this goes back to the idea of, destructive business models for quick bucks or investing so that you have a sustainable business long term, right? And we've been through this period where all the fixation has been on how do we get share prices up quick, how do we maximize margins, and not necessarily do the right thing, either for the business itself or for the world in which they're operating, whether it's for the workers, whether it's for the customers, whether it's for, as I say, the environment. None of that was really relevant. It was all about how do we get a quick buck. Well, I think we're sort of in a transition here because they're realizing, and certainly in the case of the automakers, is going to be like the oil companies, as it was with the cigarette companies before them, where yes, they covered up evidence of the impacts their products were having on the world. They continued to sell them and make great profits, and then all of a sudden the gig is up. there's a lot of damage created, and lawsuits begin, and everyone goes after, trying to get compensation for the harm done. And I think that's where we are, and that's why I think we're at a major secular tipping point for the transportation industry as well as for the energy industry, because as we've seen, the price of oil has been falling. Again, this is both a cyclical story because of the slowdown in the global economy, but it is also a secular story because of the reality that the world is quickly transitioning in our renewable energy technology, in the battery storage capacity, all these new tools that have come up. So this is a big deal, and it's a big deal for transportation too. So the companies that are able to figure it out and move over, and this is why one of the things that's been so destructive has been this buyback frenzy where they've spent, billions and billions of dollars of their free cash flow over the past many years on buying shares when they really should have been shoring up their coffers for this massive secular shift that needs to happen, because it's very investment intensive. They have to do a lot of capital expenditure. They have to retrofit their factories. They have to figure out, new lines and ways of doing things. In some cases, they have to buy technology to, strap on to what they're doing. So it's very capital intensive, and it's a long-term view more than just how do I get my profits up this quarter. And, we watch what Elon Musk has been doing with Tesla and all the derision he's received. And yes, it's extremely high-risk stuff. He's had to take on tons of debt in order to make these vehicles, which are ranked the best vehicles in the world. It's not great for short-term profits, clearly. But the way that you do that is you have to, as I say, manage for the long-term view and make sure that the money you are spending is taking you in the direction of that sustainable business model. So that's why companies, and GE is a classic example. They've wasted so much money in the past decade on buybacks, just as all the other major companies have, so that now when this big challenge to their existing business model comes and they really do have to reinvent themselves and go through a period of, of falling earnings and disappointing revenues, it's going to be quite challenging. It's just like for individuals. How do they get through periods of downturn? By having savings that's liquid and safe, not in assets that are plunging, and, being able to, and having no debt. That's the best way to make it through periods of economic challenge. Unfortunately, that's not what most households have done, and it's clearly not what most businesses have done. So this is going to be extra challenging. But the people who survive and thrive through this period, and the companies who do, are going to be the ones that see where the puck is going, that have resources to ride out the storm, who can afford to invest in their long-term business model. And then we've got some super exciting stuff happening, and the opportunities of this evolution are probably the greatest in my lifetime. So I'm actually super excited about all the innovation that's coming.
And Danielle, we'll talk about that right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, disruptive technology, AI, is it going to take our jobs, or will it enhance our jobs and our life experience?
Well, I think it'll do both. I think that there's no question it'll make certain human functions redundant or unnecessary. There's no question. That's the whole point, to try and have AI augmented human capacity. So whether that is, making us smarter, or whether it means moving more efficiently or doing tasks more efficiently with less errors, certainly AI is huge for that. And so there will be some jobs that are no more. But also what people forget is that this big disruptive phase also will rebirth or birth whole areas that we haven't seen before, that will have demand for other activities and jobs, other investment opportunities. And it's just like I've likened this many times, but the transition at the start of the 20th century, when we were moving from horse-drawn vehicles to ice engine automobiles, there was a bunch of segments of the business that lost out and were not needed and went the way of the doughbirds, and then there was a whole bunch of new sectors that came on stream. The same thing is happening in this. So whether it's, as I say, energy storage or in the healthcare sector, this is enormous in terms of efficiencies. This is going to be one of the best ways because we have such a dead weight right now, both with the sickness crisis that's come from the terrible diets, people have been eating the wrong foods, lifestyle choices, all this on top of an aging population. We've got a big bulge of weight and cost on our sick care system. So obviously efficiencies there that are driven by technological improvements are coming at a perfect time. So that's going to also free up capital for other things. So we can't, there's evolution is a part of human life. If we expect things to stay the same, we're going to miss the boat, we're going to be left behind, and we're just going to not thrive. So you have to try and figure out how to keep agility. That means in your finances, that means in your brain, and keep reading and learning about where we're heading. And there's all sorts of things to be looking forward to. It's not a negative story. In many ways, the last decade has been a very negative period, to the extent we've wasted so much of our resources on gimmicks and frauds and things that were ultimately counterproductive. But this cleansing period that I'm speaking of, when we get to actually, call a fraud, and call the legitimate players, and figure out what technologies are actually going to add to the bottom line and add to the benefit of the society overall. That's the good stuff, and that's where we're going.
Danielle, thank you so much for talking with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle, you can send them to info@howstreet.com. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.